The sell-off in US assets resumed overnight, with concerns growing about ballooning US government debt, pushing the 30-year Treasury yield over 5% to its highest level in 18 years. Indonesia cuts rates as currency worries fade away. New Zealand records a record trade surplus. And it's budget day in New Zealand. That's coming up in our 5 Things in 5 Minutes on Thursday, May the 22nd. And then, in our deep dive interview, ANZ Economist Dhiraj Nim analyses recent trends in India's trade flows as the government there looks to secure a trade deal with the United States.
Is the services trade surplus that has been an important offset to the goods trade deficit in the recent years. And I think that is the key reason why India's current account deficit has stabilized around 1% of GDP.
But first, in 5 and 5 with ANZ, US stocks, the US dollar and US bond prices are being sold off sharply again this morning on concerns about ballooning US government deficits and debt, as Donald Trump struggles to get his big, beautiful budget bill through the US Congress. As of 4 a.m. Sydney Melbourne time, the S&P 500 was down 1.3%, the Dow was down 1.6%, and the Nasdaq was down 1%. But more importantly, the 10-year US Treasury yield rose 10 basis points to a new 5-month high of 4.58%. And the 30-year Treasury yield rose 11 basis points to 5.07%. Its first time over 5% since the global financial crisis, and its highest level in 18 years. That was after a poorly received auction of US 20-year Treasury bonds. Elsewhere, UK inflation data was higher than expected, with services CPI inflation rising to 5.4% in April from 4.7% in March. But that included a round of one-off regulatory increases in utilities and local taxes, as ANZ economist Bansi Madhavani explains.
It's important to bear in mind that April inflation is not reflecting a demand-led surge, but it's rather a catch-up of prices in response to previous elevated rates of inflation. What will the data mean for Bank of England? Look, the Monetary Policy Committee has communicated that they will remain gradual in reducing monetary policy restriction.
As of 4 a.m. Sydney Melbourne time, the US dollar index was down 0.6%, the Aussie was up 0.4% at 64.44 US cents, and the Kiwi was up 0.5% at 59.51 US cents. Gold up 1% at $3,316 US dollars an ounce, and West Texas oil futures down 0.9% at $61.48 a barrel. Number 2, Bank Indonesia cut its benchmark interest rate by 25 basis points to 5.5% yesterday, as expected. ANZ economist Crystal Tan says that while the central bank has had an easing bias for some time, it has had to wait for the local currency, the rupiah, to stabilise and strengthen against the US dollar.
There's clearly concerns that growth is weaker than it would otherwise have preferred. So yes, we do think there will be further rate cuts this year. We continue to expect 2 more, 25 basis point cuts that will take the policy rate to 5.0% by year end.
Number 3, Japan's export growth fell to 2% year-on-year in April from 4% in March. ANZ FX analyst Felix Ryan says exports to the US were down 1.8% from a year ago due to lower car exports. But he says exports to the EU and China also fell.
So not just the US, but a broader story there about weaker exports. Imports as well, that was down 2.2% year over year. So overall, when we think about the BOJ and Japan growth, we did see in Q1 GDP, exports really drag on that Q1 GDP figure just recently. And so if we do see ongoing trade tensions and tariff risks, then it certainly seems like the export side of things will be a drag on the GDP of Japan.
Number 4, New Zealand reported a record monthly merchandise trade surplus of $1.4 billion in April. That was only the 4th monthly surplus above $1 billion and contrasted with a $12 million trade deficit in April a year ago. ANZ economist Matthew Galt says high export prices in key sectors like dairy and also restrained imports led to the record month.
These seem to be more traditional drivers, just seasonality and high export prices and subdued domestic demand. Some countries have seen quite a lot of volatility in their exports to the United States over the last couple of months. That's not so prominent in the New Zealand data.
Number 5, it's budget day in New Zealand. ANZ senior economist Miles Workman expects the Treasury to maintain its forecast for an operating surplus in 28-29. However, to get there, lower discretionary spending will be required to cover for higher non-discretionary expenses and potentially a lower tax take amid global economic wobbles. Here's Miles on what that would mean for the government borrowing program.
New Zealand Debt Management is on track to pre-fund some of next year's program. So they have overfunded, so to speak, to the tune of about $2.5 billion this year. So while there is likely to be a bit more pressure on the funding requirement, some of that pre-funding should be able to soak some of that up. So essentially our expectation is for the bond program to barely change from the half-year update. We've only penciled in a $2 billion increase in bond issuance overall.
Miles Workman there. Now, in today's deep dive interview, ANZ Economist Dhiraj Nim analyses recent developments in India's trade flows at a time when a number of Asian economies have reported a pickup in exports to the US as front-loading occurs ahead of tariffs being imposed. Dhiraj says that's not so evident in India's trade data.
India's export basket has become more concentrated in the recent years. We've seen the share of high-tech exports increase, substantially over the past few years, and a trend that continues. So by high-tech exports, I mean things like engineering goods, electronics, and pharmaceuticals. They account for about 41% of total goods exports and 50% of non-oil exports of India. So I think that these are the categories that continue to outperform the overall export basket. They are still growing healthily, whereas low and medium tech goods are not doing well. In fact, medium tech goods are in an outright contraction. So I think that there's a bit of a divergence in India's export performance when you look by categories.
And thinking about a potential trade deal with the United States and how that might affect things, given India's exports of pharmaceuticals and tech services.
So there are several perspectives around it. Of course, when we have to compare the Trump 2.0 presidency versus the times before that, we have to realize even if tariff rates remain around 10%, which is currently applicable because reciprocal tariffs have been suspended, and the trade deal ensures that these tariff rates are around 10% or slightly lower, they would still be higher than where they were before all of this happened, right? So in terms of exports, it's a net negative. But having said that, it is of course indispensable that India has some semblance of a trade deal with the US. It will, of course, open up more doors in a changed world for Indian exporters. Having said that, most of our exports to the US are now getting concentrated in the services basket, is what I believe will likely have greater impact on India's growth dynamics and overall export cycle. In fact, it is the services trade surplus that has been an important offset to the goods trade deficit in the recent years. And I think that is the key reason why India's current account deficit has stabilized around 1% of GDP, which is hardly anything. So overall, I think US remains a very key market, both for goods and services exports, and increasingly for services exports. And from that perspective, having a good international relation with the US is indispensable.
And in terms of the terms of trade, trends for India, how's that going?
Well, we've seen a bit of a disappointing export performance overall, in the sense that the export cycle is weak and largely moving sideways, lacking any definitive trend. And imports have suddenly picked up, possibly because domestic demand is improving in the economy. But that is the real part of the story. The terms of trade is where export prices and import prices interact. And that is where I think things are going still a bit more favorably for India, because import prices are still falling much faster than export prices, thanks to correction in oil prices in the recent months, etc. So I think that terms of trade are still evolving favorably for India, which possibly is a bit of a good news out of the broader trade data that does not speak much exuberantly about the economy and its prospects.
And how is the Reserve Bank of India likely to approach these trends? Because it likes to keep an eye on where the exchange rate's going and how the external sector affects the economy.
Well, we believe that these trade trends, as they're shaping, are not going to have much of an impact on the Reserve Bank of India's FX policy. Look, they have largely allowed the rupee to move in line with its Asian peers, which means that on a bilateral basis, the rupee has neither underperformed too much or outperformed too much. But at the same time, domestic inflation has dropped unexpectedly, rather, because food price inflation has become very, very subdued, and that may remain the case for the rest of 2025. So for the RBI, which often times gets concerned about the rupee's competitiveness, it would be enough for them to ensure that the rupee is not out of line with its Asian peers, so that low domestic inflation can ensure that currency's competitiveness remains stable, especially as watched on the real effective exchange rate.
Dhiraj Nim there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, May the 22nd. Catch you tomorrow with analysis of the New Zealand government's budget released later today. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.